How to build a high-yield dividend portfolio for passive income. Investing in dividend-paying stocks has long been a popular strategy for generating passive income. By focusing on high-yield dividend stocks, you can create a portfolio that provides consistent cash flow without requiring active management. In this video, we'll guide you through the steps to build a high-yield dividend portfolio, highlight the benefits of dividend investing, and share tips to maximize your returns while minimizing risks. What is a high-yield dividend portfolio? A high-yield dividend portfolio is a collection of stocks that pay higher than average dividends relative to their stock price, providing investors with a steady stream of income. Dividends are portions of a company's profits distributed to shareholders, typically on a quarterly basis. High-yield dividend stocks are attractive to income-focused investors, particularly those seeking financial independence or a stable income stream during retirement. In 2025, the appeal of dividend investing remains strong due to market volatility, low interest rates on traditional savings accounts, and the increasing demand for passive income opportunities. Step 1. Understand the basics of dividend investing. Before diving into the specifics of building a high-yield dividend portfolio, it's important to understand the key concepts. Dividend yield. This is the annual dividend payment expressed as a percentage of the stock's current price. For example, if a stock pays $3 in annual dividends and is priced at $100, its yield is 3%. Payout ratio. This indicates the percentage of a company's earnings paid out as dividends. A lower payout ratio suggests the company has room to grow dividends, while a high payout ratio may indicate limited growth potential. Dividend growth. Some companies increase their dividend payouts over time, making them attractive for long-term investors. By focusing on these metrics, you can identify companies that offer not only high yields but also sustainable and growing dividends. Step 2. Set clear investment goals. Building a high-yield dividend portfolio starts with defining your financial goals. Consider the following questions. How much passive income do you need? Determine the monthly or annual income you want from dividends. For example, if your goal is $3,000 a month, you'll need $36,000 annually. What is your time horizon? If you're young and have decades ahead, you can prioritize dividend growth stocks. If you're near retirement, you may prefer higher-yielding, stable stocks. What is your risk tolerance? Higher yields often come with higher risks. Be prepared to balance your portfolio between high-yield and dividend growth stocks. Step 3. Research high-yield dividend stocks. Once you have your goals in mind, start researching stocks that fit your criteria. Here are some sectors and types of stocks to focus on. 1. Utility companies. Utility stocks, such as electricity and water providers, often pay reliable dividends due to their stable cash flows. Examples: Duke Energy, NextEra Energy. 2. Real estate investment trusts, REITs. REITs are companies that own and operate income-generating real estate. They are legally required to distribute at least 90% of their taxable income as dividends, making them an excellent choice for high-yield portfolios. Examples: Realty Income, Simon Property Group. 3. High-yield bonds and preferred stocks. These securities offer fixed income payouts, often with higher yields than common stocks. Examples: Vanguard High Dividend Yield ETF, iShares Preferred, and Income Securities ETF. 4. Dividend aristocrats. Dividend aristocrats are companies that have consistently increased their dividends for at least 25 years. While their yields may not be the highest, their reliability makes them valuable portfolio components. Examples: Procter & Gamble, Johnson & Johnson. 5. Emerging markets. Companies in emerging markets can offer higher yields, though with increased risk. These are ideal for investors willing to diversify internationally. Step 4. Diversify your portfolio. A key principle of investing is diversification. By spreading your investments across sectors, industries, and geographies, you can reduce the impact of poor performance from a single stock or industry. How to diversify a high-yield portfolio. Sector diversification includes stocks from sectors like utilities, real estate, consumer staples, healthcare, and financials. Geographical diversification. Consider adding international stocks or ETFs to hedge against currency and market risks. Income sources include a mix of high-yield stocks, dividend growth stocks, REITs, and ETFs to balance yield and stability. Step 5. Evaluate sustainability and risks. High yields can sometimes indicate potential risks, such as financial instability or declining stock prices. To ensure your portfolio remains robust, check financial health. Analyze the company's financial statements, including revenue growth, profit margins, and debt levels. Monitor payout ratios. A payout ratio above 70% may signal limited room for growth or unsustainability during downturns. Examine industry trends. Understand market conditions and trends affecting the company's sector. Step 6. Reinvest dividends. One of the most powerful strategies for growing your high-yield dividend portfolio is reinvesting your dividends. Dividend reinvestment plans, DRIPs, allow you to automatically reinvest dividends into additional shares of the stock, compounding your returns over time. Benefits of reinvesting dividends: accelerates portfolio growth through compounding, increases future dividend payouts as your share count grows, reduces transaction fees by automating the reinvestment process. Step 7. Regularly monitor and adjust. Building a successful dividend portfolio is not a one-time event. To maximize returns, you need to regularly review and adjust your holdings. Here's how. Track performance. Monitor your portfolio's dividend yield, income, and growth rate. Rebalance periodically. If one stock or sector becomes overweight, sell or add to balance your portfolio. Replace underperformers. If a company cuts dividends or its financial health deteriorates, consider replacing it with a better performing stock. Potential challenges and how to address them. 1. Market volatility. Stock prices can fluctuate, affecting dividend yields and portfolio value. Focus on long-term goals and avoid panic selling during downturns. 2. Rising interest rates. Higher interest rates may make fixed income securities more attractive than dividend stocks. Diversify with other income-producing assets to mitigate this risk. 3. Inflation. Inflation can erode the purchasing power of your dividends. Prioritize dividend growth stocks to keep pace with rising costs. Building your portfolio with ETFs. For investors who prefer a hands-off approach, dividend-focused exchange-traded funds, ETFs, are an excellent option. These funds pool investments in multiple dividend-paying stocks, offering diversification and professional management. Popular dividend ETFs. Vanguard Dividend Appreciation ETF, VIG, focuses on dividend growth companies. Ichir's Select Dividend ETF, DVY, targets high-yield dividend stocks. SPDR S&P Dividend ETF, SDY, tracks dividend aristocrats. Case study: achieving $1,000 in monthly dividend income. Let's break down how you can achieve $1,000 per month in dividend income. Building a high-yield dividend portfolio is an effective strategy for generating passive income and achieving financial independence. By setting clear goals, diversifying investments, and focusing on sustainable and reliable dividend payers, you can create a portfolio that provides steady cash flow for years to come. With discipline, regular monitoring, and reinvestment, your dividend portfolio can become a cornerstone of your passive income strategy, helping you achieve financial security in 2025 and beyond. If you enjoyed this video, make sure to hit that like button. Drop a comment with your thoughts. Also, subscribe to our channel before you go. Thank you for watching.